The Fed has already cut interest rates 2 times and it's widely expected to cut rates again at the next meeting on December 18th. This is very bullish for REITs because their market sentiment suffered greatly in recent years due to the surge in interest rates. It caused their share prices to drop by about 20% on average, even as most REITs grew their cash flows by 10%. As a result, REITs are today still priced at decade-low valuations relative to the S&P 500. But with each rate cut, more money is now coming back to REITs. Money market funds are now becoming a less compelling alternative, and as this capital now comes back to REITs, they are gradually recovering to new highs. REITs are already up by 20% on average since the beginning of this rate cutting cycle, and we think that this rally will continue as the Fed keeps cutting interest rates further. But not all REITs are created equal. Some are more undervalued than others and stand to gain greater upside as rates are cut once again. Hey, this is Yos, I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 2 REITs that you should consider buying before the next Fed meeting on December 18th. I think that these REITs in particular could enjoy significant upside as interest rates are cut once again. But before I get into it, I want to remind you that our Black Friday sale is still running for a few days. So if you want to access my full REIT portfolio, all my trade alerts in real time, my REIT CEO interviews, and much more, now is the time to join us. You can enjoy a 2-week free trial, so you won't be charged anything for the first 14 days. And if you stick with us for the long run, you'll also get a $100 discount as part of our Black Friday sale. So the first REIT I'm going to discuss here is called NNN REIT. Its ticker symbol is NNN. Net lease REITs are the closest things to bonds in the equity market. That's because they earn highly consistent and predictable cash flow from 10+ year long leases with preset rents, steady rent hikes, and no landlord responsibilities. What this essentially means is that the tenant is responsible for all property expenses, including even the property insurance, property taxes, even the maintenance of the property. Therefore, the cash flow of net lease REITs like Realty Income is typically highly consistent. It's bond-like, and as a result of this, most net lease REITs have strongly recovered as interest rates were cut, as yield-starved investors redeployed their proceeds into net lease REITs. Good examples that have already surged are Essential Properties Realty Trust, which is one of our largest holdings at High Yield Landlord, as well as Agri Realty, but NNN REIT has mostly missed out on this rally and remains heavily discounted even as interest rates are getting cut. I'll put a table on the screen comparing its valuation to that of Essential Properties Trust, and you'll see that it's trading at a huge discount relative to it. This makes little sense to me because NNN is an above-average net lease REIT from most perspectives, including its management, its balance sheet, and its assets. Let's talk first about its management. It has one of the longest and best track records of the entire REIT sector. They've managed to generate 13% average annual total returns over the past 25 years, massively outperforming even the S&P 500. Moreover, they also have the longest dividend growth track record in the entire net lease sector, even longer than that of Realty Income. They've managed to grow it for 35 years in a row. Not even the dot-com crash, the great financial crisis, or the pandemic could derail their growth. Now on the balance sheet, NNN REIT has a strong BBB+ investment grade rating with a low 40% LTV and exceptionally long average debt maturities. Its average debt term is today 12.3 years, which is nearly 2 times longer than most of its close peers, protecting it from the surge in interest rates. Finally, a quick word on its portfolio. NNN's strategy is to acquire service-oriented net lease properties for the most part. These are things like convenience stores, grocery stores, gas stations, quick service restaurants, car washes. It focuses on such properties that typically enjoy relatively low rents relative to market rent levels, that have layouts that can be easily reconfigured for other tenants, and also enjoy a high land value component to mitigate downside risk. And importantly, today it has close to no exposure to dollar stores and pharmacies, which are facing growing pains and expected to suffer further from Trump's tariff proposals. This is a differentiating factor from NNN REIT when compared to other net lease REITs like Realty Income, Agri Realty, and NNN REIT, which are more heavily exposed to these struggling property types. Even then, the market seems to be punishing NNN because it's currently dealing with a few small tenant issues. One of its tenants, representing about 60 basis points of its revenue, is today in bankruptcy, and those properties will likely need to be released to another tenant. Moreover, another tenant that's a bit bigger, representing 1.5% of its total rental revenue, only paid half of its rent in the last quarter. This may seem concerning, but we think that it's just a temporary issue. The management made it clear on their conference call that they remain confident in the prospects of these properties despite the near-term setback, and therefore I'm not too worried. I certainly don't think that it's fair to discount the entire company just because it's currently missing about 1% of its rental income. Such occasional credit events are nothing unusual when you're investing in net lease properties. Yet today you still have the chance to buy NNN REIT at just around 11.5 times FFO, which is close to a 9% cash flow yield, and you earn a sustainable and steadily growing 5.5% dividend yield while you wait for the company to reprice NNN REIT at a more appropriate valuation. I predict that as interest rates are cut further and NNN resolves some of its tenant issues, its multiple will eventually recover closer to that of its close peers, potentially unlocking up to 30% upside from here. I love the risk reward, and this is why NNN is one of the largest holdings in our retirement portfolio at High Yield Landlord. As I mentioned earlier, if you want to access the rest of our portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. Now, the second REIT I'm going to discuss is called BSR REIT, ticker symbol BSRTF in the US and HOM.U in Canada, where it's primarily listed. I've discussed this REIT quite a few times on the channel, but I think it's interesting to highlight it again ahead of the next Fed meeting on December 18th. BSR is today one of our largest apartment REIT holdings at High Yield Landlord. We think that owns some of the best properties in its peer group, focusing on affordable garden-style properties in rapidly growing Texan markets like Dallas, Austin, and Houston. These markets are expected to enjoy some of the fastest rent growth and asset price appreciation over the coming decade. Even then, BSR is today actually one of the cheapest REITs in its apartment peer group. I'll put a table on the screen, compare its valuation to that of Camden Property Trust and Mid-America Apartment Communities, and you'll see there that BSR is quite a bit cheaper. We think that this discount is largely because BSR has a weaker balance sheet. It has a bit more leverage, debt maturities are relatively short, and as a result, it's more exposed to the surge in interest rates and will likely suffer a little bit more from it in the near term. But this also means it stands to benefit more than its peers from the rate cuts. Its valuation is lower, its leverage is higher, it's trading at a steep 30% discount to its NAV, and therefore the upside potential could be significant here. Simply returning to its NAV could unlock about 40% upside, and as a reminder, BSR actually traded at a small 10% premium to its NAV prior to the first rate hike. I think that it could again regain such a premium valuation in the coming years as rates are cut, even as BSR further deleverages its balance sheet and its growth reaccelerates. While you wait for the upside, you earn a 4.5% dividend yield that's paid on a monthly basis, and the company keeps creating value for you by hiking its rents, buying back shares, deleveraging its balance sheet. And so I really like the risk reward coming from a defensive apartment REIT with exposure to some of the fastest growing markets in the nation. If you thought that this video was helpful, please consider clicking the like button. That helps me a lot to keep growing this channel. Also consider taking the 2-week free trial to our REIT newsletter High Yield Landlord to gain immediate access to all our top picks for 2025. Thanks so much for your support, and see you at my next one. Bye-bye.